Hi there. In this video, we explain how holdover and rollover relief work for UK family farms and why careful tax planning matters in 2026. Hi there.
For decades, agricultural land passed from one generation to the next with near total protection from inheritance tax. That protection is shattering. Starting in April 2026, the government is capping 100% agricultural and business property relief at a combined £2.5 million per estate. Anything above that threshold faces an effective 20% inheritance tax wipeout. For large family farms, this creates an immediate liquidity crisis. The pressure compounds heavily when you look closely at the autumn 2024 budget, which spiked capital gains tax rates on non-residential business property from a manageable 10 or 18% up to 18% and 24%. These combined changes destroy the traditional farming strategy. You can no longer hold land until death, relying on probate to erase capital gains while unlimited reliefs shield the estate. To protect the wealth built into your land, you must restructure ownership before the 2026 deadline. But shifting assets now, while you are still alive, triggers those new, heavy capital gains taxes. If you freeze and do nothing, HMRC will claim a substantial portion of your acreage when the estate eventually transfers. I'm Naim, and at ProTax Accountant, we help agricultural businesses map out survival strategies through complex tax legislation. The dilemma you face is clear. You have to move assets to avoid the new inheritance tax caps, but you cannot afford the immediate cash drain of a 24% capital gains bill. HMRC provides two specific legal lifelines to defer that tax: holdover relief and rollover relief. They both stop an immediate tax charge, but their mechanics operate entirely differently. One is designed for passing the torch, and the other is built for expanding your operation. Choosing the wrong relief or filing the paperwork incorrectly will precipitate a dry tax bill, meaning you owe the government cash you haven't actually received. This is the most critical financial decision your farm will make this decade. Holdover relief is strictly a succession tool. You use it when you are ready to step back and transfer the farm to the next generation or into a trust. In this matrix, holdover requires gifting agricultural property or transferring it at an undervalue. A joint HMRC election rolls your capital gain into the recipient's base cost, meaning zero tax today. But your child inherits this latent liability, fully responsible if they later sell. Let's look at the math. Suppose you bought acreage decades ago for £200,000, and today that land is valued at £1.2 million. If you use holdover relief to gift it to your daughter, no tax is due, but her tax base is permanently locked at your original £200,000 cost. If she later sells the farm to a developer for £1.5 million, she will be taxed on a massive £1.3 million gain. Holdover relief effectively shields the farm from tax today, but it operates as a tax time bomb passed directly to your successors. Rollover relief is your expansion tool. You use this to remain in the business, but need to adapt by upgrading facilities or relocating to better land. On the right, rollover requires selling an asset and fully reinvesting the cash. The gain reduces the new asset's base cost, deferring tax. But liquidity is locked, and HMRC enforces a strict timeline. Reinvestment must occur between 1 year before and 3 years after sale. If you miss that 3-year deadline, HMRC will cancel your provisional relief and hit you with the original tax bill plus backdated interest. Rollover secures your ability to grow the business, but it demands absolute commitment of your cash and flawless compliance with the calendar. Beyond the basic mechanics, both reliefs have strict eligibility rules. For example, transferring a farm cottage that you rent out to a tenant normally fails the active occupation test for business relief. However, under a specific provision known as the letting lacuna, if you package that let cottage and transfer it as a single asset alongside qualifying agricultural land, the entire package achieves full holdover relief without apportionment. But holdover carries a lethal inheritance tax trap. When you gift the land, you initiate a 7-year potentially exempt transfer, or PET. If you die within 7 years of making the gift, the land is pulled back into your estate for inheritance tax purposes. To protect the family from a double tax wipeout, you must back the transfer with a 7-year term life insurance policy written in trust. Rollover relief has its own structural pitfalls, specifically the mismatch trap. If you sell a solely owned farm but purchase the replacement farm jointly with your spouse, HMRC rejects exactly half of your rollover claim. Selecting the correct relief on paper is entirely useless if your legal packaging and ownership structures are misaligned during execution. This flowchart illustrates how to choose. The correct relief depends entirely on your ultimate goal for the acreage. If your objective is to step back, avoid the £2.5 million inheritance tax cap, and keep the farm intact for your children, use Holdover Relief. You just have to trust that the next generation will continue farming and not immediately sell the land to trigger the deferred tax. If your objective is to stay in business, sell off outdated parcels, and purchase modern, highly productive facilities, you use Rollover Relief. You are choosing between transferring the legacy or upgrading the operation. That choice dictates your family's financial security and your operational freedom for the next decade. UK agricultural tax law is highly complex and heavily dependent on your specific circumstances. This video is for educational purposes and does not constitute formal financial advice. At Pro Tax Accountant, we structure farm succession plans, manage complex land sales, and ensure your relief claims meet HMRC's exacting standards. To start planning your strategy before the 2026 caps take effect, call our office, email us, or visit our website to book a consultation. Subscribe to our YouTube channel for more definitive strategies on protecting your agricultural business. The tax landscape has shifted, but with precise planning, you do not have to let HMRC dictate the future of your family's legacy.